One is that for the past 40 years, the United States has had, and most of the developed world, has had rising debt as a percentage of GDP, public, but falling interest rates. And so if you double your debt levels, but you cut your interest rates in half, your interest expense is still manageable. It hasn't changed. Now is that when you bounce off zero and you start going sideways to up, that interest expense actually starts to matter. And so we're kind of in this phase where for 30 years, you could kind of ignore the public debt. And now it's getting to a point where you can't really ignore it. And it's one of the sources of inflation.
Over the past few years, as the United States debt situation worsened, more people, including several prominent and iconic investors, have been talking about the country's growing debt issue and what it means for our future. But the issues have grown so bad that even the International Monetary Fund is talking about U.S. debt problems. Earlier this month, a senior IMF official noted that the forces underlying the Treasury debt market are extremely adverse as the U.S. is on an unsustainable fiscal path. Victor Gaspar, director of the IMF's Fiscal Affairs Department, also noted that U.S. deficits are elevated and they're projected to be persistent, adding that underchanged policies and debt dynamics in the U.S. are very unfavorable. The United States is forecast to post a fiscal deficit of around 6% of gross domestic product this year, even though the economy is expanding and unemployment is low. According to the Congressional Budget Office, the huge shortfalls are going to persist throughout the coming decade. The CBO notes that during the 2023 fiscal year, the U.S. government spent $6.131 trillion while generating about $4.441 trillion in taxes and other revenues. The result is a deficit of about $1.7 trillion, $300 billion more than the budget shortfall recorded in the 2022 fiscal year. In a recent interview with Rebel Capitalist, renowned macro analyst Lyn Alden discusses the U.S. debt situation and why it has become an even more pressing issue in 2023. Alden explains that the debt issue was considered an emergency as far back as the 1980s, but the economy was able to survive because of the rapid globalization and the predominantly peaceful period that followed. But all that has changed. Not only can we not rely on another rapid China-like development, the relatively peaceful period the world enjoyed over the past decades has been completely shattered. We will now bring you clips from Lyn Alden's interview. Please watch, share, and like this video. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Lastly, don't forget to drop your comments and observations in the comments section below. Thanks, and enjoy the video.
The overall long-term views are generally unchanged. These things, while individually unpredictable, tend to happen more frequently when we're in the environment that we're already in. So one way to think about it is that, sovereign debt crisis leads to war and inflation. War and inflation lead to sovereign debt crisis. It's kind of this feedback loop until you get to the next epoch. Another way of putting it is that inflation leads to disorganization. Disorganization leads to inflation. And so there's two kind of major themes I track at the current time that are tied directly together. So one is that for the past 40 years, the United States has had, and most of the developed world, has had rising debt as a percentage of GDP, public, but falling interest rates. And so if you double your debt levels, but you cut your interest rates in half, your interest expense is still manageable. It hasn't changed. And so especially in this kind of the past 30 years or so, they've had that sharply falling interest rates. And the problem now is that when you bounce off zero and you start going sideways to up, that interest expense actually starts to matter. And so we're kind of in this phase where for 30 years, you could kind of ignore the public debt. And now it's getting to a point where you can't really ignore it. And it's one of the sources of inflation, along with other things. That's kind of one of the demand movers of inflation, or just like a debasement mover of inflation. And so that's number one. Number two is the geopolitical aspect, and it ties into that because, if you look at a long-term chart of public interest expense, it was sharply rising throughout the 70s, 80s, and that was kind of the peak time when people got concerned about the debt. So the national debt clock went up in the late 1980s. And some of the early elections in the 1990s, you had major candidates like Ross Perot that were really kind of putting focus on the debt. It kind of hit a crescendo there, and they kind of got they marked almost a top because with the opening of China and with the fall of the Soviet Union, it kind of opened this big period of disinflation. So you
Right.
basically brought Western capital together with Eastern labor, And so you build up all these Eastern, Asian manufacturing facilities. You connected cheap Russian gas to Europe, and these were big. These were boosts of productivity, boosts of abundance, and disinflationary. And so a lot of those debt problems fell away, and people said, debt doesn't matter. Those people were, calling wolf, and for about 30 years that was correct. And the problem now is that mathematically, when you run into zero rate and then bounce off of zero, and when you've kind of exhausted those 30 years of like a peace dividend, and now we entering a more fragmented world. So the U.S. and China, more rivals now. Obviously, what's happening, with Russia's invasion of Ukraine and now Israel, some of these ties that have been, more solidified over the past 30 plus years are less so. And so the combination of having public interest expense actually become a problem, mixed with more challenges on the supply side, which can feed on themselves. I think that's setting up a more, on average, inflationary decade, and on average, a less energy secure decade. So higher average energy prices, risks of energy volatility. Um, and so I think that's what we're kind of optimizing for, at least from my perspective. To the extent that things changed in the past week, um, I think that I've been a bond bear since 2019, and the nominal drawdown on bonds was surprising even for me, even as a bond bear. I think that tips are starting to get a little bit more interesting from the long side. If you wanted to say rotate a little bit of capital out of, say, the Magnificent Seven equities that have just kind of gone only up, and I think that some of those, I'm not exactly a buyer of bonds in general, but I do find that the tips real yield to start being somewhat interesting.
Mm.
And also, if we do start to see kind of a stabilization in real yields, that's also what helps give gold and other types of assets some real legs.
Treasury inflation protected securities or TIPS are securities whose principal is tied to the consumer price index. The principal increases with inflation and decreases with deflation. When the security matures, the U.S. Treasury pays the original or adjusted principal, whichever is greater. With the heightening uncertainty in the market and economy, Alden believes investing in certain assets might be extremely counterintuitive. But the macro analyst gives a pass for tips, select real estate investments, and more long-term chaos-proof assets like Bitcoin and gold. The renowned financial and macro analyst believes that those who are already sufficiently invested in hard assets like Bitcoin have no need to be very worried during moments such as this. Let's get back to the interview.
For the next 6+ months, a key thing I'm watching is, so right now we have this very kind of loose fiscal environment, but obviously you have the tighter Fed environment. They're doing their best, as Chris mentioned, to slow down demand, to try to modulate what's happening. And so one thing we have to look at is how long can they maintain this? Because combination of a strong dollar, rising yields, and high energy prices does put a lot of downward pressure on the world economy. It does put downward pressure on the domestic economy. And the question is, who's going to buy all of that massive treasury issuance? So the Fed's not buying, banks are not buying, the foreign sector is not buying. Really, the only place to absorb it is domestic non-banks, and they have limited overall balance sheet capacity. And so right now, the Federal Reserve is drawing down their balance sheet, but they're also, the reverse repo facility is drawing down. And as that draws down, that actually pushes liquidity back into the financial system. And so that's been happening at a roughly equal pace. And so ever since the banking crisis earlier this year, overall domestic liquidity has been roughly flat. And the reverse repo probably has about 8 months more or so before it would be drawn down at the current pace. And I think after that, we start to get interesting questions like, can the Fed still be as tight as they are in the face of so much fiscal issuance? And I think that's where we might get more of a regime change outside of this kind of current environment. But right now, as long as the Fed's drawing down their balance sheet, I think a more risk off type of outlook makes sense. The size of the fiscal deficits as a percentage of GDP outside of recession or direct war are rather unprecedented. That's
Right.
what kind of feeds into this, what I would call kind of the early signs of basically a sovereign debt crisis. And so again, a lot of the biggest buyers are essentially leveraged, like banks, the Fed, right? They can buy very large amounts when they're buying.
Mm.
because they're not buying with finite balance sheet capacity.
Right.
The problem is that the remaining buyers, even if they do have a somewhat risk-off stance, um, they're buying with finite capacity. In addition, a lot of people are momentum traders, so when they see just bonds constantly going down, uh, they tend to get on one side of the boat. And so that's why I'm starting to mention that after this drawdown, I do think we could see a little bit of rotation here back into bonds. And
Right.
my preferred risk way to play that is the tips, because if I'm concerned about energy prices,
Hmm.
um, I'm less inclined to go with the nominal bonds, even though I think you could certainly have a tradable bottom with them. But when we look at the huge amount of supply coming to market with some of the stagflationary concerns I have,
Yes.
I still don't love the nominal trade for the bonds, but I do think that the tips are getting interesting, and I do think that if this much issuance keeps coming to market, the Fed keeps holding their situation tight, at least for the maybe next 8 months, the risk reward for the say S&P is just not particularly attractive, and that's different than necessarily saying a hard landing. I mean,
Hmm.
if the S&P 500 goes sideways for a year and T-bills pay you 5%, your hurdle rate is no longer zero; it's over 5%.
Right. Right.
And so, and then also you volatility adjust that. So even if the S&P 500 were to return 6%, if you had to have a lot of volatility to get that 6% compared to, 5%, no brainer investment, the risk reward I think favors things like, T-bills or tips at
Hmm.
the current time, at least, in terms of portfolio weightings, percentages.
While speaking at the 2023 World Economic Outlook, IMF Director Pierre-Olivier Gourniches called on the U.S. government to change its approach towards spending and taxes as the country deals with sticky inflation and high interest rates. Most worrying is the case of the United States, the IMF director began, where fiscal deficits have deteriorated substantially in 2023. Fiscal policy in the U.S. should not be procyclical, even less so at this stage of the inflation cycle. With lower growth, higher interest rates, and reduced fiscal space, structural reforms of the right kind at the right time become key. This is no longer a problem that can be wished away or one we can hope the government will eventually get around to taking care of. It's going to be persistent. By Alden's estimates for at least the rest of the decades and maybe even into the early 2030s. However, during the latest issue of her monthly newsletter, Alden noted how important it is to remain level-headed and not overly pessimistic about our chances. The concluding part of the newsletter reads, "When I talk about unstable financial systems up to and including the sovereign level of the developed world, it can come off as quite bearish. It sounds almost doomy. But it's important to remember that big monetary changes have happened before. In very few generations, the system resets itself and starts something anew. The period of change can be disruptive, but on the other side, something comes out that is either better or worse, depending on how we all work together to shape it." Alden also noted that she remains bullish on assets like Bitcoin and gold. The post further reads, "I have a long-term positive view on gold and Bitcoin given the prospect for fiscal problems ahead. But I also like T-bills, tips, oil producers, select real estate, select equities, and so forth. The past few years have been difficult for a lot of investors to navigate financially, with all sorts of unprecedented things happening that would have sounded crazy to someone in 2019. I expect the same will be true for the rest of the decade. We live in interesting times, but life goes on." Please share your thoughts on Alden's outlook and your thoughts on the US and the overall global economy in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks and enjoy.